Good morning and welcome this morning to Cryptocurrency Basics, a great new introductory series of webcasts that are designed to help you as an investor, as a trader, as a just curious person understand a little bit more about the topic of cryptocurrency. And we have the opportunity to spend a little bit of time today talking about some of the cryptocurrency basics. But over the course of this four-part series and then perhaps beyond, we're going to delve into other topics as well. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I am joined in this discussion today by Jim Ferrioli, who is the Director of Crypto Research and Strategy. Welcome this morning, Jim. We appreciate you being here with us.
Hey, Ben, thanks for having me on.
You bet. And I'm also joined out in the chat by Connie Hill, 20 plus year veteran of the financial markets. Scott Thompson, he's a longer veteran of the financial markets. I won't tell you how much longer, but they are there to help answer your questions this morning along the way as well. So as we get into this discussion, I'm going to share the agenda with you in just a moment. But as this is a new series and a new topic of discussion for us here at Schwab Coaching, I wanted to talk briefly about some disclosures and disclaimers that we need to discuss. Remember that everything that we talk about in this discussion is simply for illustrative and educational purposes only. It is not a recommendation. It is not solicitation of a particular strategy or account type or instrument. The securities, investment products, and strategies talked about are not suitable for everyone. Make sure that you have a clear understanding of these ideas before considering and making any investment decisions. There are a lot of different ways to look at markets, including technical analysis and probability analysis, as well as other factors to pay attention to. Don't rely on one single method to evaluate the market. Past performance in cryptocurrency, just like in every other aspect of the market, is no guarantee of future results. As we get into this discussion, digital currencies such as Bitcoin can be highly volatile. They're not backed at the moment by any central bank or any government. Digital currencies lack many of the regulations and consumer protections that legal tender currencies and regulated securities have. So, due to that high level of risk, investors should view digital currencies as a purely speculative instrument and additional risks apply. So as we talk about all of these things, just keep these disclosures in mind. As we get into this discussion, cryptocurrency products and the Schwab crypto account and any other aspects of that are offered by Charles Schwab Premier Bank. We'll talk more about that as we get into this discussion. A couple of other quick reminders as we get along the discussion here. We will be showing some charts today. In order to do that, we're going to be using the Thinkorswim desktop software platform, specifically the paper money version of the Thinkorswim desktop software platform. That is a great learning environment. However, it is not a guarantee of future success out there in the real world. And some of the things that a live trading account might do, the paper money platform does not do, but it is a good place to learn. So be aware of that as we talked about the technology relating to digital assets, including blockchain. It is new, it is developing. There are risks associated that are just coming to the forefront of understanding. So it is a dynamic environment, which of course is one of the reasons why it is an exciting opportunity to discuss this. So over the course of the next 4 Mondays, we're going to be talking about really a kind of a broad variety of discussions when it comes to cryptocurrency. Our focus today will be what is cryptocurrency. Our focus next Monday will be on more of the nuts and bolts of how cryptocurrency and its related products work. Beyond that, we're going to be talking about how do traders and investors gain exposure to cryptocurrency. And then our fourth in this series, our focus will be What drives cryptocurrency prices? Because for many, that is still a mystery. And in fact, the mythology and the mystery around cryptocurrency, as befitting the name cryptocurrency, seems to be perhaps one of the things that brings people to the table because they're interested to find out what's the truth, what's the reality around cryptocurrency. So, our focus today in this discussion is digital currencies, this definition of what is a cryptocurrency, this obscure concept that we have that backs all of this, which is called the blockchain, and what are the relevant risks in understanding that, and then what is this topic that we are discussing of cryptocurrency. So to bring into the conversation at this point, the starting of this conversation, I'm going to bring Jim Ferrioli back into this conversation. Again, remember, Jim is the director of crypto research and strategy at Charles Schwab, and so a great resource to have in this discussion. So, Jim, let's talk a little bit about digital currencies. There is so much mythology swirling around this, and so much perhaps misunderstanding. Let's kind of break it down to basics if we can.
Sure. So there's a lot of kind of different narratives and ideas about what cryptocurrencies are. In their most pure form, they are digital currencies. They're issued by blockchain ecosystems, and they're ways that allow you to interact with that ecosystem or other people in the ecosystem. So it's a form of money that exists entirely in digital form. There's no physical wrapper. You can't, put some cryptocurrencies in your wallet. The wallet is a term we associate with cryptocurrencies in another sense. There's no counterpart coins, banknotes. The entire cryptocurrency network, that's where cryptocurrencies are stored. So they're stored and held and created over distributed computer networks. And the biggest difference between cryptocurrencies and traditional currencies, because a lot of these features are actually somewhat similar to traditional currencies nowadays. Lots of currencies are more or less digital. The major difference is cryptocurrencies are decentralized and they don't have a central authority that supports them. So in the US, the Federal Reserve is the central authority that controls the supply of money in the economy. They're the backing of the US dollar. There's not a central authority for cryptocurrencies. These were products that were born out of the financial crisis in 2008, and by design, they have no central backer. So they have an independent monetary authority that's not managed by different institutions such as the Federal Reserve or central banks around the world. So in that sense, they're very unique to any other currencies in existence.
So that's I think an interesting topic, Jim, and I think maybe that's where, as we start to get into some of these key characteristics and ideas around digital currencies, that we have to have an understanding of, right? That understanding of fiat money, right? The ability to have as you said, a paper banknote or a physical metal coin in our pocket. We go into a store and we exchange that for something of value to us. And we do that under the auspices of this fiat idea that we have a common acceptance that this piece of paper or this piece of metal represents a certain value. And a cryptocurrency or a digital currency does not have that physical aspect to it. But now we're getting into the realm. In fact, I travel a lot for work as I go out and teach live events for Charles Schwab. And I've gone on many, many trips where I have not physically interacted with currency in my pocket, with a dollar bill in my pocket. Whether it's just using a card or whether it's using a tap to pay type of structure, where that physical aspect of currency is becoming less and less important. And so I think now we're starting to understand it. So let's talk about some of these aspects and characteristics of digital currencies. You mentioned the idea of held in digital wallets and transactions and things like that. Let's talk about that for a minute.
Sure. And so when I mention wallets, I'm not referring to the piece of leather I hold in my pocket that has my credit cards and my ID in it, right? This is a term that was used specifically to kind of help people think about it and wrap their heads around cryptocurrencies from the early days. What a crypto wallet really does, it's something that stores your private keys. So if you think about a large public blockchain such as Bitcoin or Ethereum, every single address where you can send cryptocurrencies to or you receive them from can be seen. And so your private key is what allows you to access certain addresses. And so that's what you're storing. When you hear of a wallet, it is a device, whether it's managed by a crypto exchange, a financial custodian, or a piece of hardware that you can keep at home. And that's what stores your private keys, which give you access to your funds on the blockchain. And so that's the way of custodying cryptocurrencies. Some of the
All
benefits
right.
of cryptocurrencies have been, because of this, it's instant transfer. You can instantly send money from a wallet that you control to another wallet. You don't have to go through another intermediary. And so that was kind of the original use case for Bitcoin. This was launched in early 2009. And it was originally viewed as a distributed network, a payments network with its own native currency. And so, again, it was a way to transfer money and interact with other people without a central figure approving transactions.
All
Some of
right.
the
So,
benefits.
yeah, I was going to say some of the benefits might be that speed of transaction and the ease of making that process happen. But does that mean that those entities that are agreeing to do business with that currency have to take their cut of the process too?
Well, so that's a good point. It depends sometimes. Yes, if you're using an exchange to acquire
Mhm.
cryptocurrencies, there are commissions associated with that. If you're just sending someone directly cryptocurrencies, you pay a fee. There's a transaction fee that gets paid to the network. And so that's an important thing to kind of discuss here. The way that the Bitcoin or any cryptocurrency network is maintained is through a decentralized group of validators. So in Bitcoin, we refer to them as miners. And what they do is
Okay.
every 10 minutes, they process a new block of transactions. And so the first miner to correctly solve a hashing algorithm and produce the correct output, they get rewarded a certain amount of new Bitcoin into the circulating supply and a portion of all these transaction fees from the past 10 minutes of transactions or so. And so that's their reward for being, good citizens of the respective blockchain that they're on. They're validating the blockchain. They're making sure it's decentralized, the correct versions being maintained. They're making sure transactions are posted as they should be, and they're getting a reward. So there is a fee associated with any cryptocurrency transfer.
All right. So, and we're going to get deeper into the meanings of all of these topics, like miners and Bitcoin or the blockchain and those things. So stick with us. We're kind of laying out the groundwork here. And again, this is the first of four that are going to just delve into the basics. The thing about this entire space is, and this is the reason for a lot of the mythology, is there are a lot of these terms that we talk about that seem really kind of mysterious. And again, we mentioned that at the beginning of the discussion. So we're going to break those down. But one other aspect before we jump forward here is this accessibility portion. I know the idea being that there's decentralization, there's no centralized control, there's greater accessibility, and we talk about the idea that digital currencies can allow those that don't have perhaps access to traditional banking services access to a means to pay for things or to take advantage of the characteristics of digital currencies. But that also raises some questions, doesn't it, Jim, about who does have control or why isn't there centralized control? And does that lead to the potential for things like fraud or embezzlement or other types of nefarious activities?
Yeah, that's a great topic to go into. So first, There have been instances of fraud in the past with cryptocurrencies and blockchains. Um, One of the big things is transactions are permanent. Without a central authority to reverse a transaction, if I mean to send Ben some cryptocurrency and I send it to the wrong address by accident, unless, somehow I can get in touch with whoever owns the address that I sent it to, there's no way to get those funds back. And so that's a major risk. In terms of kind of illegal activities, that's been a common criticism of these currencies. But the thing that you have to think about is every transaction that happens on a blockchain, a public blockchain, is public. You can see it. And so what people will also counter that, they'll say, sure, yes, people could do illegal, illicit activities in cryptocurrencies, but every single transaction is public and there's a chain of records. And so there's also a discouraging aspect too, where if you were to do something illicit, there's a permanent trail of who paid what happened. And so similar to any other currencies, there's always going to be bad actors. But the majority of financial and crime globally actually is paid in traditional currencies. And so it's not crypto is better, traditional currencies are better, but it's an important thing to think about when investing in cryptocurrencies. And again, it goes back to the idea there's no central authority. There's no one to say you should be doing this. There's no one to say you shouldn't be doing this. And then there's no one to step in the middle, like, again, for those accidental cases where you send money to the wrong person.
Sure. So again, going back to those disclosures that we said at the very beginning, there are specific and unique risks, and those risks are developing, and it is certainly something, as Connie and Scott have made mention of out there in the chat, that is perhaps not suitable for all investors or all participants. So the slide that I've got up right now details two different types of digital currencies. And we've used kind of both of these names here, but this is one of those common elements or common areas of misunderstanding, I think, for a lot of people that are new to the crypto space is what is a cryptocurrency and what is a stable coin? Those are the two, I think, most common nomenclature terms that you hear.
Yeah, so a stable coin, quickly, and then I'll go into a little more details, but it's a type of cryptocurrency. So cryptocurrencies is a pretty broad term, and there's lots of different types of cryptocurrencies. And so as an example, we've talked about Bitcoin. Bitcoin was originally launched as really a payments platform with its own native currency. And so that was originally viewed as a payments cryptocurrency. Now, there's another type of blockchain, and Ethereum is that type of a blockchain. And there's lots of other similar blockchains like Ethereum. And this is called a smart contract platform. So the difference between something like Bitcoin and Ethereum is Bitcoin you can use with other people who are on the Bitcoin network. You can transact in it. You can use it as a means of storing value. And that's what most people have really adopted it for. It's seen its value appreciate versus the dollar over its 17-year history. Most people don't buy everyday goods in it. They more use it as an investment. What Ethereum or other smart contract platforms do, they allow you to create programmable contracts, and to use the platform, you have to pay a fee, and that's what you would use their digital currency. So in Ethereum's case, you would use Ether to use the platform fee, and it's called gas in that term. And so just as an example, to put some real life context into it, think about it like this. You work 40 hours a week. Every day you log the hours you work. At the end of the week, your employer verifies that you've worked your hours and then initiates the payroll, and the payroll goes through, and eventually you get paid. So using that same example in kind of a smart contract context, it removes the central authority who needs to kind of go through the steps of actually getting you paid. So in that same scenario, if I can validate that I've worked 40 hours a week and I have a payroll smart contract set up, The minute my payroll is validated, it instantly executes a smart contract and I get my pay. So it cuts out the need for kind of a middle authoritative figure. And so the idea behind smart contract platforms is it's programmable money. So it's interesting from a technology perspective. Now, stablecoins are cryptocurrencies that are built on top of smart contract platforms. So the two largest stablecoins, and you've probably heard their terms maybe, are USDT, which is issued by a company called Tether, and USDC, which is issued by a company called Circle Internet Group. These are cryptocurrencies that are built on a blockchain such as Ethereum or one of their competitors. And what these are, in specifically to the two that I've named, they're essentially digital dollars. Many people like the idea of being able to transact instantly across a blockchain. They like the idea that there's very low fees associated with sending funds or purchasing something with cryptocurrencies, but they don't like the idea of holding a volatile cryptocurrency like Bitcoin or Ethereum. Sometimes it can be great to hold them. They go up, you see your holdings grow in value. Sometimes they go down, so that doesn't feel so well. So if you're using cryptocurrencies for everyday use, something stable that's pegged to the dollar might make more sense to you. And so that was the initial use case for stable coins. And they have lots of different use cases within the crypto ecosystem nowadays. But the idea is they're stable, they're pegged to the US dollar. And so it's a way to use these native digital currencies in something that's not going to bounce around in all, throughout the day in different directions.
Which is an important consideration given the fact that one of the intents of cryptocurrencies is to be able to accomplish that payment processing, not just to speculate on price appreciation or price depreciation of whatever that asset is, to use it as a tool to exchange, just like a fiat currency, something of that represents value for something that actually has tangible or inherent value, right? In it, like a pizza, for instance.
Exactly. And so if you go back to, or again, the original launch of the Bitcoin blockchain, it was meant to be a payments network. And so it's for most everyday people, you don't want the means of payment rapidly changing its price throughout the day. And so
Sure.
as the use case of Bitcoin has really turned more into an investment, a way to store value, things like stablecoins have emerged where it's, hey, if I'm going to buy something, I'd rather just use something in stable prices today than something that has
Okay.
volatile prices.
All right. So you also talked about some of those other two, the central bank digital currencies, and also virtual currencies. Let's talk about these before we jump over to the discussion of the blockchain, which is really kind of, again, that next mysterious aspect of this crypto realm.
Yeah, so another term that gets thrown around is central bank digital currencies, or CBDCs. There is not one in the United States, though there are some global central banks that have issued them. And essentially what this is, they're issuing their own blockchain-backed currencies. And so what that allows them to do is, first, it's quicker transactions. You can cut out middlemen. The reason that some people see it as a negative is because it also allows the central bank the opportunity to track and see every single transaction that happens within an economy. And there's no right or wrong answer. Some people are okay with this and some don't like it. But in some countries, they have issued it as a way to make their currencies more efficient, better for trade. In the US, it's more of a hot button issue where some people really value the privacy aspect of private money, and others seem to see the benefits in kind of having a digital currency that can be tracked, that can be traded, and can reduce some of the frictions from the existing financial system. Virtual currencies, and we talked about this earlier, if you think about it like this, how often do you spend cash throughout the week? Most
Right.
currencies are already virtual. They're already digital. When you're spending money on your credit card, if you're sending someone money through a payments application, you're not actually handing them physical money. you're having a provider uh, connect with another provider, and they're making sure their books meet at the end of the day. They're doing bulk transfers to cover these types of transactions. So it's really, again, like the idea of thinking of a cryptocurrency when you first approach it, it's like this is a very strange new topic, but most currency transactions are primarily digital today, unless you're, again, paying cash for every single transaction. Our currencies really became digital at the beginning of the internet. If you want to participate in e-commerce, if you want to do any type of transaction, you're essentially working in a digital currency. It's just the US dollar that you're using. So when you think about it from that approach, the step to a cryptocurrency isn't all that big of a step. It's just a different issuer that's maintaining that currency.
Right. I think of in this sense, in terms of kind of that broader definition of virtual currency, I think about it as somewhat similar to, for instance, the loyalty programs that we might participate in with various businesses. So, for instance, I go into my local ice cream shop and I fill out a survey. And in exchange for that, they give me a loyalty point. Or I walk in and I check in that I'm there and they give me a loyalty point, and then I can use those loyalty points in exchange for something of value to me, a bowl of ice cream, right? And so that's very much that idea of a digital representation of value that's not issued by a central bank, unless you were to call the ice cream shop the central bank, and it can be used within their online ecosystem because I can exchange it for something else, right?
Yes, another like really relatable example of this, which I'm sure everyone on this webcast knows, credit card rewards. I mean, that's the ultimate
Yep.
digital currency. You spend your credit card every month, and your credit card issuer gives you these rewards, which you can then go and book a flight on, book a vacation on, use at the grocery store. So again, it's the idea of digital currencies is something that we already have in the economy today. So cryptocurrencies is really kind of building on that idea.
Cool. So, Jim, you've mentioned this word blockchain a couple of different times, and you've talked about it in a way that I think is maybe surprising for some people, because I think the common consensus out there, or the common understanding out there, is that there is one singular blockchain, that this blockchain exists and it is this one singular entity or construct, and that's it. But you've also mentioned it in the context of there are, multiple blockchains, plural, that facilitate these various different types of cryptocurrencies. So this is one of those concepts that I think for those that are interested in this topic of crypto, that it is important to understand. So this is an area where attention must be paid to understanding this idea of what is a blockchain, how does it work, and what does it mean for us as those that are interested in crypto?
Yeah. So if you think about the blockchain, it quite literally is you're taking a series of transactions or a block of transactions and chaining them together. Every single new block of transactions, every prior block is saved in that latest block. So it's, again, it's a permanent history of transactions. So what a transaction means in a blockchain ecosystem, so this is decentralized software. When you're sending a transaction, all you're doing is you're sending a message. And the message will say, will allow you to interact with that blockchain. It'll give people access to different cryptocurrencies maybe you hold at an address. Every 10 minutes, specifically on the Bitcoin blockchain, the network races to create a new block of transactions. And so that becomes the permanent public ledger. Each new block has every other block that's ever been approved saved into it. So again, it goes back to the idea you're chaining together blocks. And the process to do this on the Bitcoin blockchain is called mining. And it was designed as a secure, transparent, and accurate way to manage a decentralized monetary system. Now, other blockchains don't use mining. They use a concept called staking. And we'll talk about that in a bit. But the core idea is to have a public blockchain where you don't need a central authority. You want different users or nodes, which we refer to, which just means different computers on the blockchain, who are competing against each other to solve this latest block so they get rewarded for it. So they're competing against each other. It results in a blockchain that's not highly concentrated with one group of people approving blocks, right? Because then would you trust it? You don't know who everyone is. So it's a very unique way to manage a distributed monetary system.
All right. So as we talk about this, I mean, again, I'm watching the flow of questions in the chat, and I appreciate the questions coming. And over the course of this series, my hope is that we're going to be able to help answer all of those questions and have you participate in this discussion on an ongoing basis. But one of the concerns that always comes up, and this is going a couple of different directions. One, because there's no central control, there's no oversight entity. But on the other side of that coin, because there's no central control, there's no one oversight entity that could become nefarious and perhaps restrict access to that blockchain. So it cuts both ways. So I wanted to talk about the risks of the blockchain, the risks of cryptocurrency as we get into this portion of the discussion.
Yeah, so we talked about this before. In the past, there have been scams. These are digital networks, so obviously there's always the risk of hacking and then fraud. One of the biggest issues with blockchains and cryptocurrencies is your passwords can be lost or stolen. Your passwords, which give you access to your wallets, which store your private keys. So again, without that central authority, if you lose your password or your address or your wallet becomes not accessible, you could permanently lose access to that money. Security vulnerabilities, hacking. Prices are extremely volatile. These are emerging currencies. They're speculative. And Bitcoin is the largest and the oldest. And on any given day, it typically will see its price increase or decrease 2.5%. So that's a very volatile asset. It has a 90-day volatility of about 50. So it's an extremely volatile asset. So things to be considered. Transactions are irreversible. We talked about this earlier. If I mean to send Ben some cryptocurrency and I send it to the wrong address, unless I know who I sent it to and they're very nice, I'm probably not going to get it back. And the other thing to think about is because all addresses can be seen, someone can send you cryptocurrencies without you approving it. And so there is always the risk that some sort of nefarious activity was the source of these cryptocurrencies, and then they get sent to you. And then finally, there's regulatory risk. There's not clear laws that have been established for most cryptocurrencies in the United States. Recently, the Securities and Exchange Commission interpreted existing laws to create a framework for people and financial institutions to understand how to use cryptocurrencies, how to think about them. But without a formal law being passed, in the future, a different group heading the SEC, a different political administration could reinterpret it different ways. And so that's always a risk. When you're investing, investors like certainty. They don't like uncertainty, even if it's something bad. As long as you're certain of what is going to happen, you can make a reasonable investment decision around it. And so again, the lack of laws that have been passed around this do result in regulatory risk.
So, Jim, this is one area. Again, I think this is perhaps the area where many that are interested in the crypto space have some concerns is around some of these vulnerabilities. The fact that because we hear the stories, right? The news media leads with these stories of the guy who has a hard disk that contains, 5,000 Bitcoins at whatever their present cash US dollar value is that he threw out, and it's now in a landfill somewhere. So he bought the landfill to try to recover the hard drive so we could recover the Bitcoin, right? We hear about the idea that people lose their pass keys, the keywords that they use to access their wallet, so they've lost control of that cryptocurrency that they held within that wallet. So those are some of the concerns. But I think just like any emerging technology and any emerging method of transacting business, those concerns are likely to be resolved, and they're inherent in the system, but they're likely to come to some kind of resolution, because you can probably make the argument that when the transaction medium was a bar of gold, people complained that it was heavy to carry that bar of gold around, and you could lose the bar of gold, and you had no way of tracking that. So they issued a piece of paper that said this represents the value of a bar of gold. You keep the bar of gold in a vault somewhere, and you exchange the piece of paper. So some of these vulnerabilities, some of these challenges may be met by new technology. But I think, Jim, one of the interesting aspects, and you talked about the idea of when we were talking about the blockchain, that proof of work or proof of staking, and the idea of having miners, is that one of the things that makes blockchain technology, which backs these cryptocurrencies, such a compelling idea is that in order to initiate some kind of widespread change to that blockchain and erase that permanent record, is that it would take so much compute power that it becomes essentially impossible to do so. Correct?
So that's a really important point to bring up. The bigger blockchains get, the more secure they become. So as an example, Bitcoin's about a $2 trillion asset. The 10 largest miners combined represent about 30 to 35% of the total network in terms of hash. And so that this the term we use to measure the computing power of the blockchain network is exahash. And so the entire network, it's about, again, the top 10 miners, only 35% total. So that means the biggest miner controls about 7% of network hash. If you wanted to say, I want to take over the blockchain network, you would have to control 51% of the network 24 hours a day, 7 days a week. And so the reason that this comes prohibitively expensive is because it's less about a digital aspect, it's physical constraints. There are real life costs to validating the blockchain. And so the first thing you need is a certain type of semiconductor built for mining Bitcoin. And right, so these are ASIC semiconductors, and so miners will have a fleet of them. Only a certain amount are made a year. Assuming you had enough money, it would be about $7 or $8 billion to just go out today and buy the ASICs needed for that. And if for some reason there were somehow enough available at that time, even though it would really take several years to ramp up that much production, you would then have to spend probably another $8 or $9 billion on the energy infrastructure of running a utility grade data center. And so ultimately, what you would result in, if you could somehow do this and one day procure all the infrastructure needed, have all the money ready to go, and not be tied down by construction and production constraints, if you were targeting that 51% share, which would be about 450 exahash, your share would grow, or sorry, the total network hash would grow. And you would actually only get about 35% of the network. And so again, it's you're eternally chasing something that you cannot capture, because as more miners are added to the network, the strength of the network increases. And so that's the ultimate thing that makes these fairly secure, is that it really is hard for one single actor to come in and take over the network. And the other thing you have to think about is miners are opportunistic. They mine when it's the most opportunistic. So those with the best equipment can run more often. Those with like older equipment or maybe higher energy costs, They only mine when it's profitable. If you want to control 51% of the network, you have to be 24/7 capturing that share. And you would just be
Sure.
bleeding money out, whether during hours where it's not profitable. And so it really becomes a problem where it's not sustainable over time to be able to do this. And so in that
Okay.
sense, it does create a secure environment.
And we're going to talk more about those aspects as well as we get further on in this discussion. Now, before we go, I wanted to talk briefly about how interested parties, investors, those who are maybe interested in this idea, can visualize the value, if you will, or the current pricing of some of these crypto assets, utilizing the tools that they have access to. Because we hear it on the news, we report it on the Schwab Network, which is brought to us by our media production company, Charles Schwab Media Production, separate but affiliated entity. But when it comes to looking at that price and seeing what that price has done over time, there are a couple of different ways that that can be done. So I'm on the Thinkorswim desktop software platform, specifically the paper money version of that platform. And I've just put together a really quick watch list of a couple of different ways that investors or traders or interested parties could look at the current pricing of Bitcoin assets. And there are a bunch of different ways that traders can gain access to cryptocurrencies. One of the ways that we're going to look at here is as a measure of what's going on in the market. We're not talking about trading these yet. We're not talking about making transactions in these yet. But what I'm going to do is I'm just going to look really quickly at a couple of the common methods to view these prices on the Thinkorswim platform. So the first one is /BTC. This is the Bitcoin futures contract. This is the continuous contract. And you can see that just in the course of, this is a 1-year daily chart, just in the course of 1 year, that price has gone from $127,637 per Bitcoin to where it is currently trading today at 71,135, or $71,365 dollars per Bitcoin. So to that point that was asked earlier and you talked about, is that there is some fair amount of volatility in these prices. If we were to take a look at Ethereum, you can see that that is a different scale. We're talking about a high over the course of the last year, up around $4,888 per Ethereum to where it is currently trading now at 1975. Now, those are the futures contracts. That's one way to view that valuation. What's oftentimes referred to as spot crypto pricing is putting the value of that cryptocurrency in relationship to another currency like the US dollar. Now, this relationship, BTC /USD, is, for those of you that have traded Forex, a common relationship. But for anybody that's looked at a stock price on a chart here at Thinkorswim, if you were to look at something like Apple, again, not a recommendation, but if you were to look at Apple on a stock chart, what you're seeing on that stock chart is Apple /USD, Apple priced in US dollars. So this next one is Bitcoin priced in US dollars, and you can see that it is very close to that futures contract. Now, this hasn't been available as a viewable chart for as long as that Bitcoin contract. But right now, you can see that the value of that price, that spot crypto, $71,165 per Bitcoin. And we can also look at Ethereum the same way. Ethereum right now trading at $1,971 per Ethereum. And again, putting those spot prices in relationship to the crypto or the fiat currency that we are using as the base for this relationship. So a couple of different ways for investors or interest parties to look at this information and see those prices. And we're going to be talking about, as we get deeper into this series, Jim, more and more about some of those ideas that we can evaluate and look at how investors can become can participate in this discussion, and how they can gain exposure in a portfolio to those ideas. So I want to pop back here really quickly and just reiterate what our agenda is going to be. We talked about the different types of cryptocurrencies. We've talked about Bitcoin and Ethereum. You talked about Tether and US dollar coin. Some of the other cryptocurrencies that are out there: Binance, Solana, XRP, Cardano, and others. But here's what we've discussed along the way here. We've talked about those digital currencies, blockchain basics, and what is cryptocurrency. And as we move forward from here, Jim, we're going to be talking about how that blockchain works a little bit deeper in that. We're going to be talking about the ways that cryptocurrencies represent that blockchain and how miners get rewarded. So deeper into that discussion. And then we're going to start to talk a little bit more about how investors can gain exposure in their portfolio. So there are some great resources out there. I know that you are talking about the crypto realm all the time. You want to talk a little bit about some of the resources that you are, some of the places that you provide your wealth of knowledge about this product?
Yeah, definitely. You should check out schwab.com/learn. We have an entire page dedicated to cryptocurrency investing. We've put out content for beginners who know nothing about it, all the way to those who have been investing in cryptocurrencies for years. So there's something for everyone here. There's ways to learn about cryptocurrencies. There's ways to learn about investing in cryptocurrencies. There's ways to kind of think about relative value comparing one cryptocurrency to another. And so I would recommend checking that out if you want to, do a bit of reading on your own to learn more about it.
Awesome. So as we go forward with this discussion, again, my thanks to Jim Ferrioli for helping us to understand this. I wanted to just, again, share, I'm going to pop this up here on the screen so everybody can see this, a couple of resources for more information. Schwab.com/cryptocurrency. You mentioned schwab.com/learn, which is our learning resources page. And then I'm going to give people two additional resources for more information. One is our Trader Talks webcast page, where as we record and archive these webcasts and other webcasts that may have crypto content, investors, clients, any interested parties can come here and view those archives. It is at no cost to you to watch those archives. All we ask is that you click on subscribe when you do that so that you can gain easy access to that information, but you can search for any of those topics. And then for the forward schedule for these particular webcasts, as well as all of the other educational webcasts that we provide here at Schwab Coaching, come right here to schwab.com/coaching, click on live webcasts, and you can see as that calendar pulls up, every Monday, at least for the next 4 Mondays, Jim, you and I are going to be together. We're going to be talking about cryptocurrency basics. So this is where you're going to go, or where you can go to log into and access these upcoming live events that we then present. So I'm looking forward to the rest of these webcasts, to the development of this product and availability of more information here at Charles Schwab. So Jim, thank you again very much for your participation today and for being here with us. My thanks to all of you for joining us as well. My thanks to Scott and Connie for helping out there in the chat, and we will see everyone again next Monday for another great webcast here at Charles Schwab.